David, the fact is we see an adjustment in yield. Does JPMorgan feel that there's a permanence to this trend, or do we go to Jan.06 and others at JPMorgan that say they see a real permanence to disinflation through the coming years?
I think I think you've got to look at the medium term and the long term. So we're going to get a surge in economic growth as this year goes on, as this vaccination finally takes hold. And I think that will push us towards full employment. I think that will push yields up. It will push economic growth up to about 5% for a year. But thereafter, I think growth slows down again. And yes, there is a long-term disinflationary trend in the U.S. economy and, in fact, in the global economy. The only thing that could upset that would be if you see a massive redistribution of income. Because I think what's really driving this is more and more income is being received by upper income households who don't spend it on goods and services. If you have a redistribution of income, if you've got less income inequality, then I think inflation returns.
Well, I'm going to go back to the phrase I've been using, folks, here. I'm typing it in for Matt right now. Then the pandemic partition, because Dr. Kelly, that's exactly what you describe. In this jobs report on Friday, are we going to see the great partition wrought by this pandemic?
Yes, we will. I mean, it's clear that the weakness that we're going to see in the report is going to be some in retail because you didn't have normal retail hiring. It's going to be some relapse in leisure and entertainment, jobs lost in state and local governments. That's all really pandemic job losses. I think the structure of the rest of the economy is actually pretty much intact. We're all very bored, but I think the structure of the economy is intact. But that's where the problem is.
David, I don't know who's bored. You have to try homeschooling. That keeps you definitely on your toes. What kind of recovery, though, are we going to see? I mean, you know, from where we're sitting in London, so not only are we in complete lockdown, but there are questions on whether, you know, you can get the number of cases under control so that you can vaccinate people properly. What if everything, you know, the recovery's pushed back by a couple of months?
Well, it could be. I mean, it'll take a while. I mean, unfortunately, the sad reality is that we are half going to deal with it through vaccination, and some part of it's going to be dealt with just through growing herd immunity because we weren't able to control the virus. But it will come to an end. And I think it's very important to think about this. In any disaster, before the disaster occurs or as it's rolling out, people think it can't get that bad. And then at the worst of it, people say it can't get any better. I mean, I remember for years after the financial crisis, people said double dip recession, relapse, another shoe to drop. And we're at the worst of this pandemic here, but it will get better as this year goes on, particularly, in fact, with regard to mortality, which I think will fall very sharply over the next few months.
But, better, yes, but will it get back to what it was like in 2019? Because that has a huge implication on how we spend, how we travel. So are we going to be, you know, social distance less by the end of the year?
Yes, I think so. I mean, I think that there will still, you know, there'll be still people who, you know, the health experts will argue that we need to be somewhat socially distant, somewhat careful. I think there'll be a lot less handshakes. But yes, I think people want to get back to normal. I think people will get back to normal. And so there'll be some parts of this pandemic economy which will persist. But in terms of overall economic activity, I think it'll be a boom all around the world by the end of this year.
David, what do you do with equities right now? I mean, forget about the moment-to-moment. The NASDAQ crushed this morning down 2.24%. Red and green on the screen as well. But what does a Kelly call on equities, given what we see in fixed income, given what we see in politics?
Well, this is clearly pro-cyclical because what's happened in politics is, I mean, this is really a watershed moment, not just the Democrats picking up these 2 seats. And we do think they'll pick, Jan.06 will win that election. But also this vote in Congress today, I think it really separates the Republican Party, divides the Republican Party into Trump Republicans and traditional Republicans. And if you've got a 50-50 Senate, I think you'll see the Biden administration try to work with some of these Trump Republicans to get, the traditional Republicans to try and get some things done. So I think you get a moderate agenda. I do think you get things done. You get more stimulus. You get more, perhaps some immigration reform. All of that, I think, is very pro-cyclical. It's pro-cyclical, that's financials, some industrials, materials, energy perhaps, but I think mainly financials are the big beneficiary here, and perhaps tech less so.
Some of you may not know this, but David Kelly schooled under Robert Goodman years ago, and you know Robert Goodman would go out David Kelly to 3 or 4 decimal points. I don't want you to do that right now. But on a 10-year yield, full faith and credit, where's a tip point where a higher yield becomes painful for our fiscal architecture? Do you have a number in mind?
Well, yes. I mean, we've got so much debt right now that every increase is going to be somewhat painful. As we go, I mean, to be honest, up until about 3%, I think that it won't prevent us from continuing to be pro fiscal policy. But as that rises, as inflation goes up, the question is the Federal Reserve going to get nervous? Is this just long rates going up, or does the Fed, they have to do something about inflation here? And that's going to be a really interesting point in time.